I'm Ryan Lightfoot-Brown of Chelsea Financial Services. We're joined today by Nicolas Trindade of the AXA Sterling Credit Short Duration Bond Fund. Thank you very much for joining us.
Thank you.
Now, can you explain to us quickly what a short duration bond is?
So a short duration bond will be a bond with 5 years or less to maturity.
And what are the benefits of investing in such short duration?
Well, if you have a fund that invests in short duration bonds, it usually comes with three main benefits. The first one is that you benefit from a lower sensitivity to moving interest rates and credit spreads, which means that usually that type of fund is less volatile and exhibit lower drawdowns. Secondly, you benefit from a much more attractive liquidity profile because, for example, in our fund, 20% of the fund matures on a yearly basis. And thirdly, you benefit from much more attractive risk-adjusted returns.
And can you invest in any bond, or do they have to be from a company as opposed to a government? And are you restricted as to where in the world you can invest?
So in this portfolio, we can technically buy both bonds from companies and from governments, but we usually mostly focus on bonds from corporates, from companies, because they tend to offer better value. We focus mostly on investment grade denominated bonds and usually from developed markets. So our exposure to emerging markets is very limited in the portfolio.
And interest rates in the UK and the US seem to have peaked for now. Is this the case, or maybe do you think are they falling? What does this mean for your funds?
I mean, as it stands today, we expect interest rates to fall in the US and in the Eurozone. And so we expect the Fed to cut interest rates 2 times this year, and we expect the ECB to contemplate a cut in the deposit rates probably this year too. Now the fund, even if it is a short duration fund, will still benefit from a fall in interest rates because it still has a duration of 2 years. And we've seen that year to date because on a year to date basis, for the first 6 months of the year, the fund is up 2% net of fees. And so it has benefited from the fall in underlying government bond yields.
And equity investors don't really like the retail sector at the moment. The high street does seem to be struggling quite a bit. Is there any attraction there for a bond investor?
I mean, it is true that it's quite an unloved sector also for bond investors. But I think it's very important to make a lot of differentiation within the retail sector. And in particular, make a differentiation between non-food and food retailers. And we think that there are potentially some good opportunities within the food retailer part of the market. And that's where actually we have most of our exposure within the retail sector.
Okay, and you've also got a holding in Gatwick, quite a familiar name to many of our viewers. Can you tell us why airports might be attractive to a bond investor?
Well, the thing is that usually airports tend to trade cheaper than the wider market, and that is because usually they tend to be more volatile, and that is because of a business model, because passenger cargo traffic tends to be highly correlated to GDP growth. And so if you have a recession, then that will be difficult for airports and you will see basically lower profits. Now, airports still offer attractive valuations, and in particular, we lack securitization from airports because we benefit from the added protection from really strong covenants and also from the security from physical assets or the cash flows of the business.
Okay, Nicola, that's been really interesting. Thank you very much for joining us.
Thank you.
And for more information on the AXA Sterling Credit Short Duration Bond Fund, please visit chelseafs.co.uk.